Marie Schrader, thanks so much. Big week for tech earnings. Facebook, Apple report after the bell today. Last night it was Alphabet and Microsoft. So what have we learned so far from the reports that are out already? Burns McKinney, Managing Director, Senior Portfolio Manager, NFJ Investment Group, and Tom Hayes, Chairman, Managing Member, Great Hill Capital. Tom, I'll start with you. Alphabet, Google, right, is at new highs. What are your takeaways from what we've seen so far?
Yeah, well, Nicole, both Google, Alphabet, and Microsoft had great earnings. The difference was the expectations going in. Google had lower expectations because of all their advertising tied to travel, leisure, and hospitality. Microsoft had high expectations. Therefore, on both having good prints, you saw Microsoft sell off, you saw Alphabet and Google rise and rally. And if you look at their historic multiples, so Alphabet trades at, for the last 10 years, their average PE multiple at 25 times. They traded up to 32 times into earnings. However, earnings beat so big that that multiple is going to come down dramatically. They came in at 26.29 versus 15.66, up 166 for the year. So as those earnings, that run rate comes up so dramatically, that multiple is going to fall down to the 10-year average, and Google looks really good here. On the flip side, Microsoft came in. It reminded me of the Apple earnings last quarter, where Apple rose dramatically into earnings, reported quote-unquote perfect earnings, and then sold off. That was a similar situation with Microsoft. It traded up to a 35 multiple into earnings versus a 28 times average multiple, and it sold off even despite beating earnings.
Yeah, absolutely. And so, Burns, I wanted to get your thoughts. I know you talk about Microsoft being helped by the pandemic. I mean, Google, too, you said, is a beneficiary of strong cloud growth. Tell me a little more about your thoughts here.
Well, I think what's interesting about this earnings report is the way that these two names are in common, as well as how they diverge. And, what they have in common is, they're probably two of the primary bellwethers of cloud computing demand. And, on this front, what they tell us is that, the demand for, digital content is still booming. Both, showed their cloud growth of north of 40%. It continued to be very strong. But also, where they diverge, and, as was previously noted, is that among the FANG stocks, Google is probably the most cyclical of these because of that ad spending. And really specifically, a lot of that ad spending is geared towards transportation. And so as a result of that, Google, I think one of the reasons why it did come in at a slightly lowered expectations, lowered multiple, was that Google was one that was hit a lot harder during the pandemic, but likewise, it's winning the rebound. It's winning the resurgence because, you saw, Google, they were clicking on all cylinders during this earnings report, but specifically the fact that the ad spending was up north of 30% was one of the things that really drove it. That, as well as the fact that, and this is something that we may look for with Apple later on today, I think investors really embrace the return of capital story for Google. They don't pay a dividend. We'd love to see that, but the fact that they had, I think they instituted another $5 billion share repurchase. They produce a lot of free cash flow. They have no net debt to put that to. In fact, they have a net cash position that, when you factor that in, you're really getting Google at nearly a market multiple. And the fact that they're now returning a lot of that to shareholders is one of the factors that the investment community really embraced, which is one of the things that drove it versus Microsoft. It just appears that, they beat the expectations. The whisper number might have just been a little bit higher. But nevertheless, it's something that, they've been consistently raising the dividend. It's been going up by nearly 10% per year over the last 5 years. As a result, this is probably a pretty good opportunity on the pullback.
And Tom, your thoughts on big tech overall? Obviously, we'll hear from Apple after the bell today. Is there still some room to run in this group?
Yeah, I think it depends. I think it's bifurcated. I think the ad providers like the Googles, and I think Facebook's going to come out very well. I think Apple, we're going to have to see about handsets and the demand because they pulled forward a tremendous amount of growth last year. So we're going to see if this upgrade cycle is dramatic. But on the Google front, I do want to emphasize the YouTube was really a big story, up 48.7%. 73% of adults in 2019 used YouTube. Now it's up to 81%. And their business is now on the go-forward run rate it could be bigger than Netflix on a standalone basis. They're doing 1 billion hours a day of viewings on YouTube versus Netflix is doing about 400 million. And if you look at the run rate moving forward, YouTube could do $30 billion. Netflix is going to do 29.78. So that's just a tremendous story. Yes, they have a small cloud business that's up 46%. And on the Microsoft side, believe it or not, the market was somewhat disappointed about their Azure business grew 50%, which is above expectations, but sequentially it was the same growth rate. So they said, oh, maybe the growth rate is slowing, and that was part of the sell-off. So I think you want to look at the ad providers over the device providers moving forward.
All right. Burns McKinney, Tom Hayes, thank you both very much. Midday Trade is next here on the TD Ameritrade Network. Thanks for being with me here on the watch list. 5 p.m. I'll see you for Market Overtime. Have a great afternoon.